So the final video is about options, and I'm going to be explaining in general what options contracts are, and then looking at Bitcoin options and the work that Arvin has done on the Bitcoin VIX. So a European option is a right, but not an obligation. Futures is an obligation. Okay, if you've got that futures contract and you're still holding it at expiry, then you're obliged to either take delivery if it's the actual grain, or settle the financial difference between the price you buy and the spot price if it's a financially settled contract. So it's a right, but not an obligation to buy or sell, and we call it a call or a put. A call is a right to buy and a put is a right to sell. The underlying at the strike price K of the option on a fixed date in the future. So, for example, I might buy a Bitcoin option, which is a call at 17,000, and so the strike price is $17,000, and the day that I can exercise this option, if I want, could be December the 20th. So if I have the right to buy at 17,000 in December, then I think that the Bitcoin price is going to continue this bull rally, and it's going to go all the way up to something, well, it's certainly going to be above 17,000, because why would I want to have the right to buy it at 17,000 in December if I think the price is going to fall below 17,000? So it's a sort of bet on the price being above 17,000 if I buy a call at strike price K at some maturity T. So the payoff is, for example, if I buy a call at 17,000 in December and the underlying price S, the Bitcoin dollar rate, were 17,500, then my payoff is 500, because I've got the right to buy it at 17,000, and I can immediately sell it in the spot market at 17,500. So that's what I would do theoretically. But actually, again, options are only financially settled. So you don't actually have to take the Bitcoin and put in an order to sell it. You just get the difference between the spot price, whatever the underlying price is. So, for example, the deribit options on Bitcoin and Ether, they have their own underlying price that is used to settle the options contracts. But because it's not the obligation, if I bought the call at 1,700 and then in December the price was 17,000 and the price was 16,000, then why would I buy at 17? Only if I could buy at 16,000 if I wanted to hold Bitcoin. So I just throw the piece of paper away. That's why the payoff to the call is the maximum of S minus K and 0. What about a put? Well, that's the right to sell the underlying at some price K on a fixed date in future. So suppose I bought a put. So I bought the piece of paper, and that piece of paper gives me the right to sell at 17,000 in December. Now, why would I do that? Well, that's because I think that the Bitcoin price is going to go way down and it's going to be less than 17,000. This rally at the moment will not be long lasting. It's going to go back down to, it was only 10,000 a month ago. It's really rallied a lot. So I think it's going to go back down to 10,000 or something. So I'm going to definitely buy that put now. Actually, makes me think I ought to. And so I pay whatever the option premium is. I'll talk about how much that is in a minute. So I buy that piece of paper, and I hold it. And then if it turns out that in December I'm right, or at least if the price has gone below 17,000, I'm in the money. So say the price is 15,000 at expiry. Well, I've made 2,000. And I just settle like that. I don't actually have to sell Bitcoin and buy back straight away. As I said, the contract is financially settled. So that's why the payoff is the maximum of K minus S, 17,000 minus 10,000 or 15,000, or 0 because I can throw it away. So we say that a call option is out of the money, or OTM, if the underlying is less than K, at the money if the underlying is equal to K, and in the money if the underlying is greater than K. I mean, it's around at the money if S is around K, okay? It doesn't have to be exactly equal, of course. And a put option is out of the money if S is greater than K, and in the money if S is less than K, so it's the other way around, okay? And most of the trading is in what we call out of the money options, because they cost much less than in the money options. I mean, if I'm already in the money, for example, the right to sell at 20,000, for example, next week, well, it's already very in the money because the price is only 17.5. I haven't looked at it later. I'll look at it at the end of this just to see. It's very in the money already, so I'd have to pay a lot for that option. Whereas if it was the right to sell at 10,000, that's so out of the money, deep out of the money put, then that wouldn't cost me anything. Tuppence, hardly anything. Now, rather than use my .cam, I decided to grab some diagrams from the internet. These are payoff diagrams. So you can see the payoff to a long call. On the left, it's the actual payoff, the maximum of S minus K. And on the right, it's the profit and loss, where we include the cost of the option. So forgetting about how much the option costs, the max S minus K 0. S here is a stock price, okay? And K is this is 50, okay? So the strike is 50, K equals 50. And I'm long the call, so if the stock price is 60, then my payoff is 10. If the stock price is 70, then my payoff is 20. This line represents max S minus K and 0, so it's 0 if S is less than 50, has a 45-degree slope. However, if it costs me 10 for the option, my actual profit and loss looks like this. If the stock price turns out to be less than the strike, so less than 50, I have to throw my option away. So I've wasted 10, okay? But if it goes up to 60, well, you know, I will exercise the option and I will get 10, and that just compensates me for how much the option cost, the option premium, as we say. The only way I'd be in profit is that if it goes up to 70 or 80. All right, so that's the payoff and the profit and loss to a long call. So here's the P&L for long and short puts and calls. So this is a long call, but you could be short calls, in which case you get the premium, the option price, and your break even would be like that. So as the price goes down, you hope that if you've sold a call, you don't want the price to go up, because you'll have to settle with this person who's bought it. When the price goes up, they start making money. So you don't want the price to go above, in this case, X is the strike price. I normally call it K. Most people do. Some people call the strike price X. Anyway, so as long as the price remains below 50 or whatever the strike price is, then I just keep that entire premium. I only have to start paying off if the underlying price at the maturity of the option goes up. And for a put option, well, it's the max of K minus S and 0. So the payoff diagram is like a flipping that way of the call payoff diagram. And with the premium in as well, we get the P&L. So you can see how you can construct all these diagrams for long and short puts and calls. Now, let's have a look at the derivative options, because these are the ones that are been studied in close detail, and they are the ones that are the most actively traded still. Although CME options are getting more and more common, and I wouldn't be surprised if Binance options and other options started making inroads to the Deribit exchange. Deribit is actually a European exchange. It's in Amsterdam, so it's a much more trustworthy exchange than some of the others. So they have 1 day, 2 day options. They have 1 day, 1 week, 2 and 3 week options. They have 1, 2 and 3 monthly options, and they have the quarterly cycle, 3, 6 and 9 months on the March, June, September, December cycle. So they have a lot of options. So they have a lot of options expiring, and they expire at 8 o'clock in the morning. It's 24/7 trading. They don't close at weekends like the CME. And the expire time is 8 o'clock UTC, which is the same as London time, except I think in the winter UTC and London go out. It's in the summer that they're the same, or is it the other way around? Can't remember. Are we UTC now? We're in November, or are we UTC -1, +1? We may be UTC +1. We're never -1. All right, so they introduce all these options, which makes it very complex compared with S&P 500. So here's the interface for Ether and Bitcoin options. Let's have a look at the live trading at the moment. Whoa, here we are, 793. My limit was hit. Yeah. Good. I doubt if it's going to stay up for very long. You never know. So, right. So my price risk, because the best hedge of all is just sell. My price risk is completely gone. Now, this is the Deribit book in options. What's happening at the moment? Let's have a look here. Just take a look on their perpetual. It's not nearly as active as BitMEX and so forth. Let's have a look at the 18th November option. There must be quite a lot of action on that one. Here we are. All right, so you can just see it flashing, coming up on the right and left. Calls and puts trading. Can you see as it changes? And all the trading really is in the out of the money. You don't get any, these are the strikes, okay? So at the moment, the strikes of 7.5 here. This is around at the money, and these are the calls. So most of the trading will be here. Oh. And there's not very much depth going into the, this is the calls, okay. On the puts, where's the puts? The puts are along here. Okay, so they sort of stuck it out right there. So the puts are bidding here and the calls are bidding there. And you can see that the prices of these, very, very high prices compared with the very out of the money calls, which are about $8. Whereas the out of the money puts are about $8, and the in the money puts, there aren't very many of them. There's only just this one, which is in the money. So the prices of options are much, much lower for out of the money than in the money. Let's go back to presentation now. Having just seen that my limit was hit Wow, really going up a lot again. Anyway, right. Right, I just grabbed this from the internet. This is the famous Black-Scholes formula. If you're in my financial risk management module, you'll know all about this because I did quite a lot of explaining about the Black-Scholes formula. But I'm not doing that in this lecture. The main point to note is that all the variables that go into this formula we know apart from one. So we know what the price is today, that's ST. Just go up here, that ST there. So in DT equals log of S brackets T, or CT, that's the price of a call, is S brackets T, times a probability, that's the capital phi D1 is a sort of probability, minus the discounted strike K, times another probability. We know the time, we know K, we know R, that's our interest rate, and we know everything apart from the sigma. We don't know sigma. And sigma is actually a volatility in a what we call a geometric Brownian motion, which is the assumptions underlying this model. And we call it the implied volatility, as opposed to realized volatility, which is something different. So we know that that formula that I just showed you is just a model price, a fair price for an option. And there's, unlike futures, where there's just one formula, there's lots of different option pricing formula. We don't have to use Black-Scholes. We could use the Heston formula or some rough volatility or local volatility or any sort of formula we want. But we don't need to, because there's a market. You can see they're actively traded, and that is the price. That's the market price, and that's set by supply and demand. So if we set the Black-Scholes model price equal to the market price, then we can get that value for sigma. So if we put that call price, CT, to be the market price, then we know absolutely everything apart from the sigma, and we can do what we call imply the value of sigma from the market price, or back out the value of sigma, knowing everything else in this rather complex formula. So there's only one implied volatility. Whether we're pricing a call with maturity T1 or maturity T2, it could be a December call or it could be a February call, whether the strike is 17,000 or 16,000, there's only one sigma. It's the same sigma in all those formulae. So if the model, Black-Scholes model, is a good representation of what's happening in the market, then those market prices should give us the same implied volatility when we back it out from every option price. But that doesn't happen. So, in fact, we find that implied volatility depends on the strike and the maturity. And so this is where I'm going to be talking about my work with Arbon in this journal, the Bitcoin VIX and its variance risk premium. So these results are from the paper there, where we look at some what we call implied volatility surfaces for Bitcoin options on Deribit. And you can see one in April 2019, where it was quite flat on the left. And the out of the money puts, that's where the moneyness is 1.2. Those are out of the money puts, had the yellow phrase there. The implied volatility was about 60%, which is already pretty high. Whereas the out of the money calls, that's moneyness about 0.9, their volatility was much, much lower. That's the blue area. Whereas in July, the volatility had jumped up, and so the out of the money puts had a volatility of, well, very short term, out of the money puts had a volatility of 120%. Over the longer term, with maturity half a year or more, the volatility was more like 90%. But again, the out of the money calls had much lower volatilities. They were higher than they were in April, but they're still much lower. And this is a typical implied volatility surface that we get from equity options, S&P 500 options, FTSE options. They all behave rather like this. So here's some more Bitcoin implied volatility surfaces. And you can see that they all look fairly standard. Now, to trace all that information as a whole surface is really hard. But instead, what we can do is we can take a sort of slice through at a constant maturity, say 30 days or 1 week or 3 months. So we take a constant maturity slice through, and then we can take that, what we call smile shape, that's a sort of curve. Well, actually, it's downward sloping line, really, but it's curvy. And we can use those prices to come up with one number, which represents the average volatility that option traders expect for example, the VIX is what they expect on the S&P 500 index. So you take the prices of all the out-of-the-money options, because they're much more actively traded, and you use those to get implied volatilities, and then you put them all together in one number. And what you do for each strike, you make a sort of synthetic, because it's not always going to be a 30-day option available, but you sort of interpolate an option price, and then you weight each of the prices by the inverse of the square of the strike. So the low strike, that's out of the money put options, have a higher weight than high strike, that's out of the money call options. And then you add them up, and that gives you something called the square of the VIX. And when you square root that sum, you get something called the VIX. Okay, now we first started looking at the Bitcoin VIX way back in July. It's our first publication. We called it the BitX then, but now we call it the BVIX. And Arben was at Technical University in Munich, as you can see. We put the name on the graph there. And that had reached an all-time high of 140%, but it's been going higher since then. And we calculated this index for constant maturities of 7, 14, 21, and up to 4 weeks, but also 30 days, 60 days, and 90 days. And you can see the sort of standard term structure of fluctuating between contango and backwardation. So just at the beginning of April, there was a period of backwardation, high volatility, with the 7-day volatility be higher than the 90-day volatility. That's the backwardation in the curve of volatility. And then between the second half of April and the second half of May, we had the more typical contango, when volatility in general was lower and the 90-day BitX was higher than the 7-day BitX. And then you can see periods where the volatility in general goes up and we go into backwardation, and then it goes down and we go into contango. Now, this is the methodology document actually already available on the Crypto Compare site for the BVIX index, and this is the 30-day index that we've developed with Crypto Compare. I hope that by the time you watch this video, it will be live. I'm told it's going to go live next week, but I was told that before. And I'm sure that Arben can show you it during the seminar. The Bitcoin variance risk premium is the payoff to a variance swap. Remember, there was realized volatility minus the variance swap rate. So if we use the BVIX, not just this one, but we can use different maturity BVIXs as payoffs to variance swaps, with realized volatility being defined over 7 days up to, say, 28 days. And here we defined it on a pretty high frequency. It was every hour. So it was the hourly log returns over 7 days. So we took the average squared hourly log return over 7 days for our realized variance. And then the BVIX index for 7 days was the difference between the realized and the BVIX index is what we call the Bitcoin variance risk premium. And again, This behaves very similarly to an equity risk premium. There are periods of very high positive risk premium, but most of the time it's small and negative, which means that the people like GSR that are writing variance swaps, so they are paying realized and receiving the variance swap rate, they would most of the time be making money, but during periods of high volatility, like right now, one would expect that GSR would be probably losing money on their variance swaps unless they were hedged. So that's it. And I'm going to stop the video now and end the recording.